If you're doing the accounting for your own business or someone else's, there's always a chance that you or maybe even the person before you made some sort of mistake in a prior year that still needs to be adjusted to make sure that your financial statements are accurate and up to date. Maybe you miscategorized some sort of expense transaction. Maybe there was a bill that was actually paid in real life, but it wasn't marked as paid inside of your accounting software. There's a million different reasons for why these corrections need to be made. What you do need to know is that there are two main ways to go about making these corrections, depending on whether your books have been closed and your tax return has been filed. I'll break down both of those methods depending on your situation by jumping into QuickBooks Online and showing you exactly what you need to do. But real quick, my name's Arthur. I'm the founder of S&G Bookkeeping, an accounting and bookkeeping firm that works with small businesses across the US inside of QuickBooks Online. And I'm also a certified advanced pro advisor in QBO or QuickBooks Online. So I've had to deal with this for my own clients and in all of the trainings that I've had to do. And I just want to pass along this information to you if you have noticed any errors in your accounting software. So for method number one, this one's actually pretty simple. If the books have not been closed or the tax return has not been filed for that prior year, so let's say we're in 2025 and you want to correct something in 2024, if that tax return or the books have not been closed for 2024, then all you have to do is find that transaction that's causing the issue and then manually make that change inside of your accounting software. And I'll show you how to do that right now. We are in the sample company here for example number one, Craig's Design and Landscaping Services. So let's search for an expense in the prior year. We are in 2025. Let's look for one in 2024. I already filtered this so we can see that. But let's say we have this expense, Books by Bessie. And in this case, we know that Books by Bessie, she is our bookkeeper. So I don't know why we have inventory asset. Looks like we made a mistake here. But so we know that this should be classified as a bookkeeping expense rather than an inventory asset. And obviously this would apply to any transactions that you have for your business. You would obviously have a better idea of what they should be depending on the prior transactions that you've had with those vendors and so on. So in this case, we know that Books by Bessie should be our bookkeeping expense. So all we can do, once again, if the books are not closed and the tax return has not been filed, we can just recategorize that by going to the category and then retyping in that correct category. Then we can save and close that right there. Or as well, if you didn't, let's say you couldn't find that specific transaction, you're not sure exactly when it took place, you did your search function and you still couldn't find it, what you could do is if you knew that exact category that it was labeled as and the exact dollar amount, what you can do is come over here to the top left, press plus new, and then journal entry. And essentially, you would just have to get as close of an estimate as you could. So I know that was on November 30th. So let's say we knew that date, or you knew an estimate of that date, so you can do something around that date. Just try to be as accurate as possible with these estimates. And so we know that was categorized as an inventory asset when it shouldn't have been. And it should have been a bookkeeper asset or bookkeeper expense right there. So you can see legal and professional fees. So essentially with that original expense, what we did is since we categorized it as inventory, we increased our inventory amount by $1,500, meaning we debited it. This is kind of the behind the scenes of what's going on in that transaction. But anytime you, let's say in this case, we increased our asset account, in this case it was inventory, that's essentially a debit. We want to cancel that out by doing the opposite, crediting it for $1,500 and then replacing that reduction in the inventory asset by increasing our bookkeeping fees, which is what it should have been in the first place. And you could just type in $1,500 right there. That'll increase your bookkeeping expense, which is what we wanted at first, and reduce your inventory asset, which is also what we wanted since that was the original mistake that we made. And you could make a little entry here. You could say reclassify inventory to bookkeeping expense. And then if you want, you could also add a little bit more specifics for November 24. Just to be as specific as possible. And once again, you should add a name here, Books by Bessie. And this is assuming that you didn't make that change to that original bill, that original transaction that we looked at. this one right here, let's say you didn't touch that, that's when you would make that journal entry if you couldn't find that specific transaction. So those are the two main ways to go about making those entries when the tax return has not been filed or the books are not closed. They end up doing the same thing, but make sure you don't do that once for the journal entry, one for the transaction. Otherwise, you're going to double count that expense. We want it just one or the other. So now for method number 2, if the tax return has been filed or the books have been closed for the prior year, we're going to do something a little bit more different. It's a tiny bit more complicated, but don't worry, I'll explain it right now and hopefully make it a lot easier to understand. So let's hop into QuickBooks Online and I'll show you what to do. So now for method number 2, we're going to assume that the tax return has been filed and the books are closed. Let's go back to that same expense transaction, Books by Bessie. As much as we would love to just go in here and change that category, type in bookkeeping expense like we did previously, we can't do that. And the reason for that is if the books are closed and taxes have been filed, changing anything in 2024 would actually impact our taxable income. So if we change this to bookkeeping expense, that would actually reduce our taxable income and reduce our liability for taxes, which sounds like a good thing, right? But having to file an amended tax return is just not worth it for many businesses, because CPAs that do these amended returns, they could charge hundreds or even thousands of dollars. And there's also a bunch of burden that comes with it from the administrative side, because you need to regather all of the proper documentations to redo that return, and it's just a pain in the ass. So saving a couple $100 is just not worth the hassle for these smaller businesses that we work with. So essentially what you would have to do is to make sure that your numbers are still correct, but avoid having to amend your tax return, you would have to do a journal entry and make sure that it's not in the filed period. So in this case, 2025 has not been filed, 2024 has, so we don't want to do 2024. We don't want to touch those numbers there. We're going to keep it as of 2025. It's perfectly fine to do the January 1st, 2025, like I mentioned, as long as it's not in 2024. And we're going to do something similar, but a little bit different. Essentially, our inventory asset is still going to be a credit to $1,500, just like we did in the previous journal entry. We want to reduce it by $1,500 since we accidentally originally increased it by $1,500. So this will cancel it out, making our net inventory change 0, which is what we wanted. We had nothing to do with inventory with that purchase. And our other account is actually going to be called retained earnings, also for $1,500, in order to balance out the debits and credits. And the reason for this is retained earnings. It's basically kind of like you can think of it as a holding account for all of your net income. So anytime you have net income for the year, it goes into retained earnings, and this is a balance sheet account. It's called a stockholders equity account. So the more income you make, the more retained earnings become. So any of your net income is just funneled into here. And now by debiting this, we're actually decreasing our retained earnings, which has the same exact impact as increasing our bookkeeping expense like we did last time. So we're decreasing our asset and we're decreasing our retained earnings, because think about it. If we had increased our bookkeeping expense by $1,500, our net income would have gone down by $1,500, meaning we would have had $1,500 less of net income going into retained earnings. And this essentially does the same thing by reducing that that retained earnings by the same amount. So same thing, different account, just so we don't touch that prior year. And it's also important to note that whenever you're doing one of these prior year adjustments with a filed tax return or the books are closed, you never want to use a profit and loss account. You only want to use an asset, liability, or stockholders equity account. In this case, we have our inventory asset. Retained earnings always going to be stockholders equity. One of these other accounts have to be one or the other, whether, like I mentioned, asset, liability, or stockholders equity. And that's because of the accounting equation. ALE, assets equals liabilities plus equity. We know that if we're decreasing our stockholders equity account by $1,500, we also have to decrease our inventory asset account by $1,500 to keep that equation in balance. So that's why you only want to use balance sheet accounts. Now, I also recommend making a note. You could call it reclassify inventory asset to bookkeeping expense in November 24. Just if you ever look back at this transaction, you have a better understanding of why you made this. And then also, if you want, you could I recommend just throwing in Books by Bessie so you understand who this retained earnings transaction is for. It's like we mentioned, it was for that bookkeeping expense from Books by Bessie. So that just gives you a bit more extra detail about that. So Once you finish that up, you made your descriptions, added your name, you should be good to go. I know it can get very complex trying to understand all of these things, understanding when to make the adjustment, what accounts to use, and so on. So if you do have any questions, drop them in the comments below for us. We'll get back to you as soon as possible. As always, thank you for watching, and stay tuned for our next bookkeeping video coming up to help you out, some small business owners.